There's a question that comes up in nearly every conversation I have with someone who is 5 or 10 years from retirement. It usually sounds something like this. What happens if I need a nursing home for years? What if I get dementia and it costs everything I've built? And I want to say something important before we go any further. That fear is not unreasonable. Long-term care is genuinely expensive. The consequences of being unprepared can be severe, and the uncertainty of it, not knowing whether it will happen to you or how long it might last, makes it especially hard to plan around. But here's where I want to reframe things. The problem isn't that the fear exists. The problem is that most people are framing it incorrectly. They're planning for the worst case scenario as if it were the guaranteed scenario. And that misalignment between fear and data leads people to either dramatically overspend on protection they'll never use, or freeze entirely and do nothing because every option feels overwhelming. Today, I want to do three things with you. First, we're going to look honestly at what long-term care actually costs in this country, using real current figures. Second, we're going to examine how people typically pay for it. And third, we're going to walk through the three main strategies for covering that cost, not as a sales presentation, but as a genuine side-by-side comparison of trade-offs. My goal is clarity, because when you have clarity, you can make a decision that actually fits your life. Let's start with the numbers, because you can't plan around something you haven't actually looked at directly. Here are the approximate annual costs, nationally, for different levels of care. Adult daycare programs run roughly $18,000 to $27,000 per year. Home care, meaning a health aide who comes to your house, costs somewhere around $60,000 to $75,000 annually. Assisted living facilities average closer to $76,000 per year. Memory care, which is specialized assisted living for cognitive conditions, runs about $96,000. A semi-private room in a nursing home is around $118,000 per year. And a private nursing home room can reach $136,000 or more annually. Those numbers, looked at in isolation, can feel paralyzing, especially when you start doing the mental math. 5 years of memory care, 10 years of nursing care. The total figures become enormous very quickly. But this is precisely where the conversation tends to go off course. Because most people look at those annual costs and assume they represent their likely future. And that's not what the data shows at all. Let me walk you through something that I think will genuinely change how you think about this issue. When you look at observed lifetime long-term care data for people who reach age 65, here's what actually happens across the population. Roughly 52 out of every 100 people will never use paid long-term care at all. Another 12 or so will spend under $30,000 over their lifetime. About 18 to 20 will spend somewhere between $30,000 and $300,000, and approximately 14 to 15 will spend over $300,000, the scenario most people lie awake worrying about. Take a moment with those numbers. What they tell us is that about 85% of people do not experience catastrophic long-term care costs. About 15% do. So the financial challenge here is not average risk, it's tail risk. It's planning thoughtfully for a scenario that is real and serious, but that affects a relatively small percentage of people, while not allowing that planning to consume the financial flexibility of the much larger group who will never face it. This is a subtle but crucial distinction, and it shapes everything about how we should think about the three options we're going to discuss. Before we walk through the strategies, I want to be specific about who this conversation is most relevant for. I'm going to call this group middle-class wealthy, and I want to define that term carefully because it doesn't mean what it might first sound like. I'm talking about households with roughly $500,000 to $3 million in total net worth, often with $750,000 to $2 million held in retirement accounts and taxable investment portfolios. These are people who have done a lot of things right over a long career. They've saved consistently, invested intelligently, and built substantial balances. They're comfortable, but they are not insulated from large financial shocks in the way that someone with $10 million or more might be. And this group sits in a uniquely vulnerable position when it comes to long-term care, for one specific reason. They almost certainly won't qualify for government assistance. Medicaid has strict asset limits, and most people in this wealth range are well above them unless they engage in very deliberate planning years in advance. VA benefits exist for those who qualify, but the eligibility criteria are specific and many people don't meet them. That means if someone in this group faces multi-year, six-figure long-term care costs, they are likely paying for it from their own assets. And while $1.5 million sounds like a lot, and it is, 5 or 6 years of high-cost nursing care can reduce that balance dramatically, potentially altering retirement income, interfering with legacy plans, and creating real financial stress for a surviving spouse. This is the group that needs a strategy. Not because catastrophe is guaranteed, but because the downside is significant enough to plan around thoughtfully. When someone in this wealth range does need long-term care, it generally gets funded through one of three approaches. They pay out of pocket from savings or investment accounts, they draw on a standalone long-term care insurance policy, or they access benefits through a permanent life insurance policy that has a long-term care rider attached. Each of these approaches is valid in the right context. None of them is automatically the right answer. They solve different problems, and they each carry their own set of trade-offs. So let's look at each one clearly. This is the approach most people default to, often without really deciding on it consciously. And when done with intention, it can actually be the most efficient strategy for the majority of people in this group. The core idea is simple. Rather than paying ongoing insurance premiums to hedge against a risk that may never materialize, you intentionally set aside a portion of your portfolio and designate it as your long-term care reserve. You invest it, you let it grow, and if you end up needing care, it's there. If you don't, it belongs to you or to your family after you're gone. The first objection I almost always hear is, how much do I actually need to set aside? And this is where a lot of people make a mistake. They assume they need to have several $100,000 sitting in a separate account the moment they retire. They don't. Most long-term care expenses don't occur in early retirement. They tend to cluster in later retirement, typically when someone is in their late 70s or early 80s. That means if you're retiring today at 55 or 60, you don't need the full amount liquid and waiting. You need a reasonable starting sum invested in a way that it can grow to where it needs to be over the following 2 to 3 decades. If your goal is to have $300,000 available by age 80, and you're currently 55, you have 25 years for that money to grow. At a 6% annual return, you'd need to invest approximately $70,000 today to reach that target. Not $300,000 today, $70,000 today, with time doing most of the work. Based on the data we reviewed earlier, a well-funded bucket in that range would comfortably absorb the low-cost and mid-cost scenarios, which together represent the majority of people who do use paid care. It gives you breathing room in a high-cost situation before you have to make major decisions. It delays any need to involve Medicaid, and if you're fortunate enough to never need it, it passes to your heirs as an inheritance, which, if you have legacy goals, is genuinely meaningful. The honest limitation of this approach is that it doesn't fully protect against the most severe outlier scenarios. If you or a spouse requires multiple years in a high-cost memory care facility or skilled nursing home, even a well-funded bucket can be significantly depleted. About 1 in 3 seniors will have some contact with skilled nursing care during their lifetime. For most, it's a shorter-term stay, often following a surgery or medical event. But approximately 15% of those who enter skilled nursing care near the end of life will remain for more than 2 years. That 15% of roughly 35% means we're talking about a fairly small subset of the overall population. But it's a real scenario, and it's worth acknowledging. The other requirement of this approach is discipline. If you designate money as a long-term care reserve, it has to remain reserved. Tapping into it for vacations, home renovations, or lifestyle expenses, and then assuming it will still be there when you need it, defeats the entire purpose. For someone who is in reasonably good health, has solid savings habits, is comfortable with the statistical realities, and has a spouse or partner in the picture, This approach often represents the most straightforward, lowest cost path with the most flexibility. Standalone long-term care insurance is the option most frequently discussed and most heavily marketed. It's also, for many people, the least efficient option when you examine it through the lens of actual data. But there are specific circumstances where it genuinely makes sense, and I want to give it a fair hearing. A standalone long-term care policy is designed for a fairly specific profile, someone who is moderately wealthy, but not wealthy enough to fully absorb a catastrophic care scenario, is genuinely risk-averse, and, this part matters, has personal or family health factors that suggest a higher than average likelihood of needing extended care. That might include a strong family history of Alzheimer's or other dementia. It might include multiple close relatives who spent extended periods in memory care or nursing facilities. Or it might reflect individual health indicators that elevate the odds above the population average. When that's the case, the expected value calculation shifts. The risk profile is no longer average, which changes how we should evaluate the cost of coverage. For a healthy 55-year-old purchasing a new policy today, the rough annual premiums might look like this. A single man might pay around $2,500 per year. A single woman, because statistically women tend to live longer and use more care, might pay closer to $4,000 annually. A couple purchasing coverage together could easily pay $5,000 or more combined. That typically purchases a daily benefit cap, a cumulative lifetime benefit pool, and some level of inflation protection, often around 3% per year. Over 20 to 25 years of premium payments, that cost accumulates. Even at the starting rates, you could easily pay $100,000 or more total premiums over the life of a policy. And long-term care insurance premiums are not fixed. They are not level premium contracts. Insurers have the ability, and have historically exercised it, to raise rates over time. On average, policyholders have seen rates increase by up to 100% over the past decade. That means the premium you pay at 55 could plausibly double by the time you reach 75. A more realistic total lifetime premium cost for a couple, accounting for increases, may land closer to $200,000 to $250,000. Most policies have an elimination period, typically 30, 60, or 90 days, during which you pay out of pocket before the policy activates. Benefits are capped at daily maximums and lifetime maximums, and if you exceed those caps, the cost reverts to you. Qualifying for benefits requires documented medical evidence that you can no longer perform 2 of the 6 standard activities of daily living, or that you have a qualifying cognitive impairment. Claims require formal approval, which is not always a smooth or immediate process. And if you go your entire life without needing to access the policy, which, as we've established, is the statistically more likely outcome, there is no residual value. No cash to reclaim, no death benefit for your heirs, no refund. The premiums are simply gone. This is the element that makes this option psychologically difficult for many people, and honestly, it's the element that makes it financially inefficient for the majority of retirees in average health. When you look at the data, 52% chance of never using paid care, about 70% chance of lifetime costs under $300,000, you're paying for decades of premiums to protect against a scenario that statistically doesn't materialize for most people. For many policyholders, total premiums paid will equal or exceed the value of benefits received. None of that means it's always the wrong choice. For someone with a documented family history of dementia, for a single retiree with limited family support and no buffer against a prolonged care situation, for a household that genuinely prioritizes certainty over flexibility, the value here is not purely financial. It's the ability to sleep at night knowing that a specific, defined worst case is covered. And that peace of mind is real and worth something. It's just worth being honest with yourself that you are buying certainty, not efficiency. Those are 2 different things. This is the option that tends to generate the most confusion, both because it's less familiar and because it gets tangled up in debates about permanent life insurance more broadly. So let me be transparent about something upfront. I'm a firm believer in keeping investment costs low. I believe in index fund investing and in using insurance for its intended purpose, to protect against financial risk during a defined period of need. As a general principle, I'm not an advocate for whole life insurance as an investment vehicle. For most people, term life insurance combined with consistent, low cost investing produces better long term outcomes. But personal finance is personal. Some people already have permanent life insurance policies that they've maintained for years. They intend to keep those policies. And for those people, the conversation about long term care riders looks quite different. It's not a question of whether to buy whole life insurance, it's a question of what to do with the policy you already have. Here's how a long-term care rider actually functions. You can typically access 1% to 4% of the policy's death benefit per month to cover qualifying care costs. Benefits activate under the same general criteria as standalone long-term care insurance: the inability to perform two of the six activities of daily living, or a qualifying cognitive impairment. The benefits received are generally income tax free, and every dollar used to pay for care reduces the remaining death benefit accordingly. The cost to add this rider is typically $600 to $800 per year, significantly less than the annual cost of a standalone long-term care policy for someone in their 50s or 60s. This cost difference is relevant, but only when compared correctly. Adding a rider to a policy you already have and intend to keep is a very different calculation than building a new whole life policy from scratch specifically for long-term care purposes. Suppose a spouse purchased a $500,000 whole life policy at age 40. A rough annual premium for a man might be $6,000 to $8,000 per year. For a woman, perhaps $5,000 to $7,000. These are intentionally wide ranges. Actual premiums vary by insurer, health classification, and policy design. But let's use these figures as a working baseline. If that person maintains the policy from age 40 to age 80, the total premium outlay is somewhere between $240,000 and $320,000 over 40 years. By age 80, a reasonably structured whole life policy might have accumulated a cash value of roughly $180,000 to $250,000, along with the remaining death benefit if long-term care benefits were never accessed. If they add a long-term care rider later, the incremental annual cost might be $600 to $800 per year. That gives them the ability to access 1% to 4% of the $500,000 death benefit monthly, or $5,000 to $20,000 per month if care is needed. Benefits are generally tax-free, and unused death benefit remains in place for heirs. The psychological advantage here is meaningful. Unlike a standalone long-term care policy, this approach eliminates the use it or lose it dynamic. If you never need long-term care, the full death benefit passes to your heirs. If you do need care, you access the benefit when it matters most. Either way, the money you've put into this policy has some residual value. It doesn't simply disappear if you stay healthy. For people who have long resisted standalone long-term care insurance precisely because of the possibility of paying decades of premiums and receiving nothing in return, this framing can make a real psychological difference. It's important to be honest about the limitations, too. The total long-term care benefit available is constrained by the size of the underlying policy. This isn't designed for someone whose primary goal is to maximize long-term care coverage. A standalone policy with higher benefit caps might serve that purpose more directly. Rider premiums are generally not tax deductible in the way that certain standalone long-term care premiums may qualify for deductions. And if you're starting from zero, no existing permanent policy, no intention to use permanent insurance for any other purpose, building a whole life policy specifically as a long-term care vehicle likely doesn't make sense from a cost perspective. The long-term care rider approach is best understood as a middle ground hedge, not the lowest cost option, not the most comprehensive, but one that integrates naturally into an existing plan, reduces the emotional friction around wasted premiums, and creates a defined coverage ceiling without requiring a separate policy structure. Imagine a healthy couple, both age 50, with solid retirement savings. Given the population data, they face roughly a 52% chance of never using paid long term care, about a 30% chance of lifetime costs under $300,000, and approximately a 15% chance of very high extended care expenses. If they choose to self-fund, they might designate $200,000 as a dedicated long-term care reserve. Invested at a 6% average return, that $200,000 at age 60 grows to approximately $640,000 by age 80. That covers the vast majority of realistic scenarios. It buys meaningful time in a high-cost situation, and if it's never needed, it passes to the next generation. The cost here is primarily opportunity cost and the discipline required to leave the money earmarked. If one spouse purchased a $500,000 whole life policy at age 40 and they add a long term care rider, the incremental cost is modest, perhaps $600 to $800 per year. The rider creates a capped hedge for catastrophic care while preserving legacy value if care is never needed. The trade off, higher total lifetime cost than self funding, but less exposure to the single worst case scenario, and no regret around wasted premiums. If they purchase a standalone long term care policy starting at age 50 at, say, $5,000 per year combined, and they hold it for 30 years, the nominal premium total is $150,000. Accounting for the rate increases that are historically common in this product category, a more realistic average premium might be $7,000 to $9,000 over time, bringing total lifetime premiums to roughly $200,000 to $250,000. On top of that, there's an elimination period, benefit caps, a claims qualification process, and no residual value if the policy is never used. The benefit, defined, comprehensive coverage for catastrophic scenarios. The cost, financial inefficiency for the roughly 85% of the population who will never need it at that level. There's no version of this where one option is cleanly superior. These three approaches solve different problems for different people, and the right answer depends on your health history, your risk tolerance, your existing financial structure, and what trade-offs you can genuinely live with long term. That said, for a generally healthy individual or couple in this middle-class wealthy range, here's how I think about the three options in terms of where they tend to fit best. Self-funding a dedicated long-term care reserve is the most defensible default for the majority of people. It aligns with the actual statistical distribution, it keeps your assets under your control, it avoids paying for insurance against a risk that more likely than not won't materialize at a catastrophic level, and it doesn't create the kind of psychological rigidity where you're afraid to spend in retirement because a policy you've been paying for is waiting for a worst-case scenario that may never come. This approach works especially well for married couples, where partners naturally provide support to each other, and for people who are in good health without strong personal risk factors for extended care. The permanent life insurance with long-term care rider is, in my view, the most practical insurance-based solution, but only when an existing permanent policy is already in the picture. The incremental cost is lower, the regret factor is significantly reduced, and it integrates naturally with legacy planning. If you have a whole life policy you're keeping anyway, this is worth examining seriously. Standalone long-term care insurance makes the most sense in specific, defined circumstances. Someone with documented family history of dementia or other conditions that genuinely shift their personal risk profile above the population average. A single individual without a built-in care network or the financial cushion to absorb prolonged care costs. Or a person whose primary value in financial planning is certainty and who is genuinely willing to pay a premium for the elimination of worst-case risk. For that person, in those circumstances, the cost is acceptable. It's buying peace of mind in a way that has real value. There's one more thing I want to address directly because I think it quietly shapes a lot of poor decisions in this area. Long-term care fear, in its most common form, tends to lead to one of two unproductive outcomes. Either people purchase expensive coverage they never fully use and spend decades of retirement reluctant to access their own money because they feel like they need to protect it, or they do nothing, avoid the subject entirely, and arrive at later retirement without any framework at all. Neither of those outcomes serves you. The goal of long-term care planning is not to eliminate all uncertainty. That's not achievable anyway. The goal is to understand the realistic range of outcomes, select a strategy that addresses the tail risk without sacrificing your ability to live well in the meantime, and then actually let yourself live. If you have a dedicated long-term care reserve or a defined coverage strategy in place, that knowledge should give you permission to be more generous with yourself in the years when you're healthy and active. The point of planning for later isn't to deprive yourself of now, it's to hold both futures clearly, the one where everything goes smoothly and the one where you need care, and build a structure that honors both, without requiring you to live in fear of either. If this conversation has prompted you to think more clearly about where you stand, here are a few grounded steps you can take. Start by looking honestly at your current net worth and what you realistically have available to designate as a long-term care reserve. You don't need to open a separate account immediately, but you do need to know the number. Next, consider your personal health history and your family history. If you have close relatives with Alzheimer's or other conditions requiring extended care, that's a meaningful input into your risk profile, one that might shift your calculus towards more formal coverage. If you have permanent life insurance already in place, contact the insurer and ask specifically about adding a long-term care rider. Get the numbers. Understand what it would cost, what benefit access it would provide, and how it would interact with the death benefit. And if you're genuinely uncertain or if your situation is complex, work with a fee-only financial planner, someone who is compensated for advice and not for selling you a product, to review your options in the context of your full financial picture. Long-term care planning is ultimately an exercise in honest probability. It asks you to look at a range of real futures, some requiring significant care, most not, and build a strategy that can handle the range without being paralyzed by the worst end of it. The data gives us a clear picture. Most people will never face catastrophic long-term care costs. A meaningful minority will. The right planning approach acknowledges both realities, either dismissing the risk or inflating it into something that dominates every financial decision you make. Fear, as understandable as it is not a planning framework. Data is. And when you build a plan that's grounded in what's actually likely while still protecting against what's genuinely possible, you create something more valuable than any single financial product can offer: the freedom to move through retirement with clarity and confidence. I'd encourage you to take one concrete step this week, whether that's calculating a starting number for a self-funded reserve, reviewing an existing life insurance policy for rider options, or scheduling a conversation with a financial planner. Small, deliberate action is how long-term clarity gets built. If this conversation gave you something useful to think about, I'd genuinely love to hear your perspective in the comments, including what strategies you're currently using or considering when it comes to future care costs. New videos go up every week here. If you found this valuable, sharing it with someone who's navigating these same questions is the best way to make sure the conversation reaches people who need it. I'll see you in the next one.